My name is Laurie Spengler. I'm a non-executive director at the Institute, and I lead our international development work, and it's my privilege to lead the conversation we're about to have. Engaging with global perspectives is an opportunity, if not an invitation, for action and for learning. The social and environmental issues that underpin our impact pursuits, they connect us across the globe. Of course, we all recognize local context is specific and it is relevant. It must be considered in designing and delivering impactful solutions. And yet the core issues underpinning these solutions are familiar. The Sustainable Development Goals were framed, in fact, as global goals. They're not EU goals. They're not North American goals. They're not emerging market goals. They're global goals. So whether we're talking about gender equity, livable cities and affordable housing, clean energy, quality education, these aspirational objectives, they resonate with each one of us, no matter where we sit in the world. And using that dual lens of action and learning, there's a lot happening globally. The market for impact investing has exploded over the past couple of years across geographies, across asset classes, across themes and sectors. Market sizing initiatives are always somewhat challenging, but the real point of these market sizing numbers is that there's a real growth. So if you look conservatively of what is identified specifically as impact investing, in 2017, it was referred to as a market of about $100 billion. By 2019, it's well over $700 billion. If you take a broader view and look through the lens of sustainable investing, we're talking in the multiple trillions of dollars. But perhaps more importantly are the investable opportunities. The Sustainable Development Goals Business Council identified over $12 trillion of investable opportunities when we look through the prism of the goals. The number of actors participating has also increased and expanded in types, and we see that around the Institute itself in our ecosystem. We have family offices and foundations. We have individuals increasingly, corporates, and a range of institutional investors, from insurance companies to pension funds. And lastly, I would say we see the building blocks that really are so critical to strengthen our collective work also maturing. We now have common language. We have a development of coherence around impact management standards. We heard that from Mark Carney this morning, and it came through in Sarah's panel just now. And also, we should all recognize there are organizations like the Institute operating in 33 countries now across the globe. These are really exciting developments. So to help us get our arms around these developments and put them into perspective, I'm joined by 4 leading practitioners, each of whom brings a unique perspective from where they sit and what they do. We have Jacco Minnaar joining us from the Netherlands today. He is the Managing Director of Triodos Investment Management, which is a pioneer and frankly a top asset manager and investor in all things impact. We have Neha Bhatnagar joining us from India. She is the head of partnerships and research at the Impact Investors Council in India, and she'll give us the perspective on the ground from one of the most dynamic markets in the emerging markets consideration set. We have James Hicks from the UK. He is the impact data lead at the Impact Management Project, one of the really essential building blocks, impact management, as we think about our work and growing the solidity of our work. And we have Rosemary Addis from Australia, Executive Director of Impact Strategist and a Global Ambassador of the Global Steering Group on Impact Investing, who really brings a comprehensive perspective on the trends and the actors in the global field of impact investing. The individual bios of our speakers are available on our website, but we're going to jump right in. The format, just like the prior panel, we have a Q&A that'll be curated by David Krivonek, our colleague at the Institute. So I encourage people to post any questions in the Q&A window, but I'm going to kick off, Jacco, with you. Wearing your investor hat with your emerging markets expertise, give us a sense of the breadth and depth of opportunities that you're seeing today in impact investing.
Yeah, thank you very much, Laurie. Well, you mentioned the SDGs, and the SDGs are global, but of course the gaps in terms of development are largest in emerging markets. So that is where we actually see enormous potential. And this is across SDG themes. This is about combating poverty, it's about tackling climate change and developing renewable energy. It's about access to health services. It's about sustainable agriculture. you name it. Now, I think it is important, and from our experience working in emerging markets, is that development is often seen as a problem, but the flip side of a problem is that it is an opportunity, because in most of those cases, it means that there is an enormous growth market because there is a lack of things that improve the quality of life. There's a lack of services, there's a lack of some kind of assets. So these are typical situations where impact and return can go hand in hand. And we have examples of that. We have built a long track record, for example, in financial inclusion. We now are managing around 1 billion in assets under management only in that sector. Same, for example, in renewable energy and tackling climate change. And there our exposure in emerging markets is now also growing faster than in Europe. I think what is important for investors to understand is that you don't always have to go direct, because in the beginning it may be difficult to think how you're going to make those investments. But as a first-time investor, you may want to consider some of those funds that already have a track record. And as you said, apparently more than 700 billion is already invested in pure play impact investments, and several institutions, amongst them also the IFC, the World Economic Forum, are estimating this market to be above 10 trillion. So huge opportunities.
Yeah, it's great. What I love, first of all, Jacco, is you're framing this of the lens of opportunity. Investors invest because of opportunity. And so, as you say, we see need, but it translates into opportunity. So I love your focal point on that. And then the sectors that you've mentioned. On funds, can you just go one step further and give us a sense across asset classes? Are you seeing, and you're quite right, investors who are not directly in some of these markets may find it challenging, and it may not be the most efficient to invest directly in an enterprise. And there are vehicles of all sizes and stripes, and Triodos has exposure across the asset class continuum. Can you just give us a sense of some of those aggregated vehicles that you're leading or that you see in sectors across asset classes?
That's a good point, Laurie, because I think when people think about impact investing, they often think about the private equity space, and that is a very important space to have very direct impact. But it is not the only asset class through which you can go. So also in listed bonds, in listed equity, in private debt, in structured finance, there are opportunities. Structured finance, typically, of course, for infrastructure projects like renewable energy. So I think also depending on where, as an investor, you have your preferences or where it fits your mandate, there is ample opportunity.
And one of the challenges that you know all too well is that investors, as you've alluded to, have risk, return, liquidity objectives, constraints, appetites. So we've got variety across the asset classes. Maybe could you just give a spotlight on one of the examples where perhaps you attracted an investor for the first time coming into impact who had to overcome and kind of think about how that investment opportunity fit into their broader portfolio? Because you have money across the board, from the individuals all the way to big pension funds. So maybe just one example of a newer entrant to one of the funds managed by Triodos, and just how that calculation, the kind of analytical prism of thinking through their risk, return, liquidity, driven by the impact pursuit, but how they got there in the end.
Yeah, well, I think there are easier entry points and there are more difficult entry points. But for example, if investors start in the listed or in the bond space, it often is a language that they are very, very comfortable with. And then there are almost no barriers. And we see that the risk return profiles of those type of funds also really hold up well. And there's a body of scientific evidence to suggest that. I think it's a bit more difficult on the private side, where you set impact, risk, return, liquidity. And so in emerging markets, investors often have a perception that the country risks are very high, that the currency risks are very high, and that the investments are illiquid. And often, therefore, they start with a relative small portion of their funds. But they can do two things. One is, I think they can upfront really look at the track record of those funds. But our experience is that if they actually take the leap, and once they are in there, then they find out that their perception of risk are actually much higher than the actual realized risk.
I'm so glad you focused on the perception of risk, because I think that's so helpful. I mean, risk is real, people have to look at it, but oftentimes the perception is much greater in magnitude than the actual risk. And how do you work through that and navigate? I think also your point about an on-ramp being in the fixed income area, we just heard from the last panel that there is investor appetite and interest and familiarity with that product suite. And so it's oftentimes it makes sense when we're looking for newcomers to enter to focus there as an initial step, as you say. And that's great, Jacco. Thanks. We're going to come back to you, but I'm going to move on to Neha for the moment. So we've heard from Jacco from the broader investors' perspective in emerging markets. You're sitting in one of the most dynamic emerging markets in India. So Neha, give us a perspective on the ground. How would you describe what's happening there from an investor interest and actual deployment of capital perspective?
It's been 10 months. I'm still getting used to the virtual world. Sorry. I was
no
on. Thanks, Laurie. And I would, it's a fantastic question. And I'm quite excited to be a part of this panel. And thank you for having us here and, being a part of such an illustrious panel to represent India. I would like to break my response in two parts. One, introducing Indian impact investing with facts and figures. Two, example to reiterate the achievements of SDGs in India. So Laurie, with the fifth of the planet's population, India plays a major role in how close or far the world is able to come to the SDG achievement in a decade ahead. India has a huge untapped market potential for impact investors, as you all know. To help you walk the last decade of Indian impact investing, the enterprises in India have collectively raised close to 10.8 billion US dollars into 550 for-profit social enterprises, impacting close to 490 million underserved, mostly low-income communities. As you know, traditionally traditionally in India were focused on financial services as a sector. But the last decade has catalyzed several highly innovative delivery models across sectors, particularly well suited to help the SDGs related to the three core social sectors: agriculture, healthcare, and education. In fact, COVID-19 has pushed the healthcare services immensely. Digital transformation with AI solutions that never existed before, and remote healthcare is seeing a lot of interest from investors today. To give you an insight into the last 2 years, 2019, 2020, most of the exits in India took place in healthcare and financial inclusion. In fact, LGT Lightstone, Aspada, Umidiyar Network, Sequoia Capital India invested in maximum number of deals in financial inclusion sector during the first half of 2020. Interestingly, even 60 enterprises were able to make, raise close to 1 billion US dollars in the first half of the calendar year. Jumping on two examples, I'm immensely proud to share the story of a non-banking finance company called Minnaar. They were launched in 2011, which provides fast, flexible, and collateral-free loans in the range of 2,000 US dollars to anywhere close to 35,000 US dollars to micro, small, medium enterprises. And the impact that they created in 9 years was, something close to 22 million US dollars was dispersed to 35,000 customers. So you see, the impact investing is in sync with SDGs. It is advancing rapidly in India. And, out of the pool of examples that I wanted to share today, India has a lot of content. There is another smashing effort that I would like to mention, to speak in the SDG terms, Grameen Capital. They enabled 6 SDG impact bonds in 18 months, starting in 2019. The details are available on the web. So to bring the many facts I quoted together, India is at a significant crossroads in the history on the onset of a new era while achieving the SDG goals. And to quickly take another minute to end my thoughts, unsure how many of you saw this, but recently at the G20 summit, India was confirmed as the only G20 nation on track to meet the climate change goal. To work in parallel, we at ISC are putting our efforts towards, the climate tech. We have worked our way to understand that very little information on climate tech is available. So to support, we are building a research report. We are hosting a mini flagship event in July, and I hope to see you all there. So, with the hope of more support for emerging markets from international investors, I hand it over back to you, Laurie.
Yeah, that's, I mean, fantastic. And as what really comes through in your comments, it's the size, the scale, the dynamism, also the interplay with our first panel between environmental and social needs and objectives and opportunities. And my question within that framework, and of course there's real track record also, what I love about some of your examples, there's real track record here, which gives investors confidence that they can participate as things grow. With COVID, and we know all of us are suffering through COVID, in the Indian market, what the trends that you described, because there were that quite robust raising of capital in the first part of 2020, have you seen any major pause or or interruption, I would say, of some of the trends you're talking about, or no? Are we kind of able to navigate through COVID because people are seeing the need and the opportunity in things like healthcare and financial services? How would you describe the impact of COVID?
There has been, that's a fantastic question. So, some of the sectors are definitely in fact, they're getting more limelight that like, healthcare, as I mentioned. But from an international investor point of view, I think it is time that there is more engagement with the fund managers and portfolios to understand what exactly, if there is a flexible finance or an extra pool of capital, especially during these times, is required. So I think, that might be a good idea. But I think we are on track. Yeah.
Super, super. Neha, we're going to circle back to you, but I'm going to move on for the moment to James. And thank you for those great comments. So James, impact management keeps coming up in every conversation because obviously we're talking about impact. How are we managing and measuring the impact results of these investment activities? You're right at the heart of this with the impact management project. So give us a sense of what's happening. I alluded to a convergence around standards as a real momentum builder for the investment activity, but give us a sense from your vantage point on what's happening with impact management.
Thanks, Laurie. So first, I'd like to start just by saying happy birthday to the Institute. What a wonderful milestone. So delighted to be part of the discussion today. So on the question of convergence of impact standards, I think I'm almost like to start maybe a step before that and talk a little bit about convergence, about some key concepts before then coming on to standards. So
excellent, thank you.
Familiar with the IMP. We're a forum that brings together people to build consensus on how to measure, manage, and report impacts on sustainability. And between 2016 to 2018, we conducted a very public conversation in which we brought together people from a range of disciplines to see if there's any agreement on some of these key concepts that should underpin any impact management. And I definitely don't have time to go into the detail here, but one of the main outputs of the conversation, and something that many people agreed with, was that impact management is not some special kind of asset class. Actually, it's a mindset, it's an approach that can be applied across all investments. In other words, all investments are having an impact, whether you acknowledge it or not, and that impact can be positive and it can be negative, and what matters is the degree to which you are managing it to reduce the negative and increase the positive. And through our conversations, the market developed a categorization of the spectrum of impact, which we divided into 3 buckets of A, B, and C. And in other words, is the underlying asset A, acting to avoid harm, so reducing negative outcomes, B, benefiting stakeholders, so maintaining positive outcomes for those already experiencing them, or C, contributing to solutions to social environmental problems, just generating new positive outcomes for those previously not experiencing them. And since developing that concept, we've seen numerous investors, different types, take that forward both at the individual fund level all the way up to multi-asset class owner, as a way of communicating impact across the investment value chain. Now, I said I'd come to standards. What's important to recognize is that the IMP isn't a standard setter. We work closely with standard setters, one of which is the UNDP. And what's so encouraging is that we have seen the UNDP take forward that concept of the ABC and build it into their SDG impact standards. I'm looking across to Rosemary here as well, because I know she's playing a key role in helping develop those standards. But what you'll see in those standards is this crucial role that social and ecological thresholds play in determining whether something is positive or whether it's negative, meaning, you know, if an outcome is below a threshold trending towards it, then we're acting to avoid harm. If it's above the threshold for a positive outcome, then we're benefiting stakeholders. And now that notion of the threshold, which is so central to the ABC, is also showing up in regulation as well. So the EU taxonomy for sustainable activities outlines those performance thresholds for a range of economic activities. If the threshold's met, then it's considered sustainable. If it's not, then it's considered unsustainable. So different labels, yes, but what's important to recognize here is that we're seeing consistency in some of these core concepts across standards. And I think that is really encouraging in terms of better decision making for investors. And Laurie, I use that term investors in the broadest sense, because funds and fund managers, yes, but also you or me or anyone else that's doing some kind of investing through their savings. It's standards that are helping us move towards consistency in knowing whether something is good for the world and whether it's not. And, you know, we all have an interest in that.
I love that point, James. That's so right. Accessible consistency is what I'm taking away from your remarks and the work, of course, of the Impact Management Project. And we're delighted at the Institute to be an ally in the work that you're doing. And what I love that you broke it down for us into the kind of the analytical components. You don't get to standards unless you've earned your way there. And so the framework that you've talked about, the spectrum of impact, is fundamental to getting to the level of standards. But I do think it's about accessible consistency. And listening to the comments from the day, starting with Sarah and then Mark Carney and the earlier panel, I mean, this allows us, as you say, to make informed decisions for informed choices, but also to understand where capital is not flowing. Because I think with all of the excitement, and we certainly want to embrace the excitement and the momentum around impact investing, I think the conversations that we want to make sure we're having are also the transparent conversations about where that capital really is flowing and where it's not flowing and what is happening. And I think your work is so fundamental to enable us to have that conversation. So thank you for that. And we're going to circle back again, James, to you. But I want to ask Rosemary, whose name has come up several times already, as the person with this extraordinary global perspective on what's happening, the history, the trends, the arc, and specifically the actors who are now very vibrantly part of our community. And so, Rosemary, I really want to turn to you to give us your thoughts on the recent trends from the perspective of the players who are around our community of impact investing.
Thanks, Laurie. And I am going to depart a little bit from some of the technical conversation, the conversation about products and markets, to talk a little bit around when we talk about the actors, giving it a context. And I think what's important, and it's really highlighted by what James was talking about, is that we're seeing more people come on to the pathways forward that acknowledge that everything we do has an impact, and we want to see more of that impact be positive and less of it be detrimental. And we need to see more positive contributions that are sustainable for people and the planet. And there'll be lots of paths forward, but we need to agree that's the direction of travel. And it's stunning to see that we had been backsliding in relation to the SDGs, and what's happened through COVID and some of the extreme climate events we've been seeing is how quickly we can slip. And that should be the equivalent to us of a big wrong way turn back sign that keeps us very focused on these paths forward. And we've seen also how quickly we can adapt. You know, our perceptions of what is a good investment, you know, used to include tourism businesses seem to be, you know, have infrastructure and reliable revenue streams and lots of things that we like in investments, and have been severely affected. And I'm being a little bit glib, but I think it's important to the point. We've also seen people quickly take up telehealth and other things. And I want to touch on a couple of things that we're seeing in the markets that don't come up in the context of individual transactions, but do speak to the movement in markets. A lot of impact investment has grown up through private markets, in some cases, perhaps more in the UK, for example, with some input from government and policy settings. But we're seeing for the first time much more activity in the public markets, both in terms of equities, but also the bond markets. And what's significant about that is that it takes us potentially more quickly to scale, as long as we are paying attention to the things that you were talking about, of making sure that money is actually going to things that will take us forward in a positive direction and reduce the harms. In those bond markets, we're seeing governments be more active and, as we heard in the last panel, linked to some of the social outcomes. What's important there is it's also creating pathways for governments and even some of the middle income countries and lower income countries to enter these markets and build confidence, because they're linking the capital to advancing the Sustainable Development Goals, and Mexico is a recent example of that. And we're seeing institutional investors not only mobilise with their capital, but with their signalling power. And I think this is a really important point about activating the whole value chain. And so the group, for example, initiated by the Japanese pension fund, GIPF, which started to speak to markets in a way that was really quite different, saying, if you're looking just at your organisational revenue streams and not at the impacts that you have on other stakeholders, then you're not attractive investments for us. This is a real shift in the interactions. And as we've heard, we've seen the accounting and other standard setters really start to mobilise. And in the context of a pandemic where people have become much more conscious of the social and environmental impacts around them, and much more connected in some ways to their thinking around that, we're also seeing some shifts in norms. You know, Rio Tinto, which was an organisation that prided itself on its engagement with community, was not only criticised, but it was the investors who really took up the charge of saying it was not okay that you blew up a mine site, or sorry, a cultural site that had 46,000 years of history to it, to build a new mine, even though that stacked up financially. And I think what this is showing us is that, you know, economists have been telling us for some time that we've misaligned the social, environmental and the economic, and whether your cup of tea is Michael Porter or Joseph Stiglitz or Mariana Mazzucato, they're all fundamentally saying that we need to address this. And in areas like climate change, where the risks are really quite existential, there's a clear and growing appreciation of the financial impacts of that, but also that this is systemic and that it will have real implications for investors and for value creation. But what we've seen this year is that that has such a human face too, that interaction has a face of people who've lost their jobs or who are getting ill, or health systems that are failing, scars on the landscapes, whole corridors of wildlife that are in danger. And that brings an urgency to it. We've passed the 1 degree threshold. We cannot come back from that now. All we can do is stop making it worse and try to transition and rebuild. And if we allow investments that are not paying attention to that to continue, if we're not finding pathways forward, we end up not just with stranded assets, but with jobs and communities lost. We end up with spillover effects of domestic violence, of mental health issues, as well as significant effects in our environment. So I think there's a lot we can do to help drive greater alignment around this. And James has mentioned some of the points. The SDGs are such a powerful tool to point us to where the action is needed and to help us address that holistic, much more integrated approach. And we won't achieve that, though, if we see SDG alignment as classifying activities differently, or a few additional things that we're doing, which may be very valuable, but just aren't actually shifting us closer to where we need to go. And so paying close attention to some of that, and as James was saying, bringing the people who understand the need much more into the conversation as well is going to be really key, and that will help us keep to that true north on the path forward.
I think that is such a great point to conclude your initial remarks with, Rosemary, because I think oftentimes in these conversations we somehow separate out the supply side of the equation, the capital, from what we're solving for, the demand side of the equation. And ultimately, as impact investing community, we want to make sure that we are responsive to the real needs of people, of planet. And so I think your articulation of that is fantastic and a great reminder. So thank you for that. We're going to go to Q&A. We've got a number of questions in the chat room, and I'm going to turn to David in a minute. But the first one, there's a theme that keeps coming up, is people are saying, you know, look, you're all helping me see that there is a growing and vibrant opportunity set globally that's also linked to some of the things that I care about in my home market. So how do I pursue it? What's a concrete action? Like, how can I get going from each of your vantage points? What would be a suggestion you would make, recognizing that the people who are listening today, you know, we're a diverse community. We're not all institutional investors. We're not all individual investors, but we care about impact investing. So maybe Jacco, if I could start with you, what would be a concrete action I could do to get started? Oh, I think we lost Jacco for a second. Neha, I'm going to go to you. So same question, especially in your context in India. What could I do, thinking about some of the constraints I'm going to have on risk return liquidity, but what could I do to pursue something in India?
Okay, I think Jacco is back. Do you still want to go first?
Oh, you go ahead. You go ahead, Neha. You go ahead, and then Jacco can follow you.
Okay, all right. Sorry, so for the last 30 seconds, Laurie, your voice was not very clear. I'm so sorry about that.
Just a concrete action a concrete action an investor can take in looking at opportunities in India.
Okay, all right. So yeah, that's a great question, and I think it's time that we, you know, the international investors do something differently while investing in India or, you know, the emerging markets. And I'm going to relate this to your earlier question as well. You know, how the sectors, different sectors are being affected during COVID, and you know, how international investors can come together to address that issue. So, you know, having worked at an industry body for nearly 7 years now, I think, and having immense number of interactions with the investors, what I feel is that they do have an obligation to be engaged with their fund managers and portfolios, as I was saying earlier. So, you know, extra pool of capital, over communication with their fund managers, to mobilize help, provide short-term working capital for more flexibility might be a great idea. And lastly, and not because I'm a part of an industry body, I would strongly love to see more interactivities and you know, knowledge exchange series between the international investors and a catalyst, probably an Indian you know, industry body, essentially to fill the gaps.
Great. Three really tangible suggestions. Love that. Reach out more deliberately to fund managers on the ground who have the market proximity and knowledge. Think about other instruments, short-term liquidity. We need that. I mean, we all need that everywhere, but certainly in India, you're seeing that. And then the knowledge exchange series, I can certainly assure you this is an area where the Institute will be active, and in the coming, we already have been, but this is an area where we'll continue to be active. So thank you for that. I look forward. Jacco, over to you. Concrete action that someone can take now, recognizing some of the tolerances and constraints they might have.
Yeah, no, I think if we talk about concrete action, we have to realize that different players may have different angles to look at our sector and may have different entry points. And so if we look back, then some of the early movers were often individuals, high net worth individuals, foundations, family offices that one could say had an impact first type of approach, but at the same time also wanted to have a decent financial return. What we see nowadays is that institutional investors, gatekeepers, at the banks are also becoming really interested because what they see is that there are nowadays quite a number of strategies that have a track record that they can actually assess. What they see is that those track records show a risk return profile where the risk is lower than that perceived risk they had that I talked about earlier. What they also see that if they look at it as part of a portfolio, that it actually adds value because most of the impact investments have a very low or even negative correlation to listed equity and to bonds. So if you summarize, I think it depends a bit where you stand and what type of investor you are, or if you're an advisor, what type of client you have. Some come more from the impact side, some come more from the diversification risk return side, but we see that in both segments, there is increased interest in our sector.
I think it's fantastic, and it picks up on how Mark Carney framed the conversation at the beginning, right? He was speaking through the lens of finance first investors who are seeking impact. And what you're saying is no matter where you are, whether you're impact first, finance first, or however you even articulate it in your own thinking, there's a place for you to jump in. So it's no longer you have to wait for something. There's actually a full range of opportunities along both the spectrum of capital and the spectrum of impact that can accommodate your starting point. But I think implicit in what you're saying, Jacco, and this has been my experience, is that your starting point will not be your stopping point. And once you get started, it's an and, not an or. And you tend, and Rosemary, you alluded to this as well. So I think your invitation to get going is a great one. So thank you for that. I'm anxious, James and Rosemary, I'm going to go ask David for questions coming out of the Q&A, just so we get to a couple of those, and I might ask you to take the first ones that come. So David, what are we hearing from the Q&A?
Some couple excellent questions in the Q&A. Thanks, Laurie, and thanks to all who have asked. I think one that I know Rosemary is very interested in that I think would be great is a question relating to gender smart investing and how you can apply a diversity lens in your work and in your investment decisions.
Thanks, David, and thanks, Laurie. And thank you for the question, because I think it's a really important one that, first of all, recognises that not all of the effects are evenly spread, and that it helps us to put different groups in frame. There's some great tools around in terms of a gendered lens on investing, those that have been developed by CEF working across the globe, those that have been developed by the Criterion Institute, and the dimensions of it, I think, are important because a lot of the conversation about gender investing goes almost immediately to kind of women-led enterprises, and I think it's important to look at the whole picture of the things that help to improve the outcomes for women and girls and in where they sit in the family structure. So understand the context, particularly relevant to where it is that you're investing, the types of investments that you're making, and take a holistic view about the things that will matter for the outcomes for women and girls.
I think that's so good. Thinking about women across the whole value chain, from consumers to employers to the entrepreneurs, I mean, all the way through. I think that's a fantastic reminder, Rosemary. David, another question from the Q&A?
Yes, maybe one that is actually directed at the IMP and James. A question particularly on some of the most interesting markets you've noticed have been adopting increasingly converging impact management standards. And I suppose a sort of associated question with that is how, from the perspective of an investor, you can take advantage of this ongoing convergence, and also perhaps it might be useful to flag some resources that might be useful in terms of navigating the impact management landscape.
Great, thanks, David. Yeah, so I mean, on the question of kind of the geographic spread of the IMP, I mean, obviously, because of the genesis and where we started based in the UK, like we're very, we've had a lot of interest in Europe, but really over the years since we ran those consensus building exercises, we get inbound contact from all over the globe of investors that are interested in joining this conversation on a shared understanding of impact, and are just taking it upon themselves to incorporate this way of thinking into their investing. So, you know, the US, Asia, African continent, really it's all over. In terms of the second part of your question, so I mean, the first thing I'd say that if you're an investor that is new to impact measurement and management, I really recommend not starting from scratch with your impact management approach. I mean, yes, the industry is young in the big scheme of things, but at the same time, so much work and thought has gone into many of the resources that are available. You know, and I think there can possibly be a perception sometimes that adhering to a standard is sort of by default, I don't know, boring or burdensome, but I think that's the wrong way of framing things. Like, standards are developed by drawing on this weight of experience that surfaces best practices. And so using a standard should ultimately save you time and prevent you from making mistakes that others have made before you. So in terms of navigating to useful resources, I mean, through the IMP website, you can find information on the IMP structured network members. And these are 16 standard settings organizations that we work with who are putting great time and effort into articulating how their standards fit together and can be used in a complementary way. And together they cover this full range of enterprises and investors. And we're working with these organizations on a deliverable that will describe this in detail to be released next year. But in the meantime, you can find links to each of their content through the structured network page. And then I guess the second thing I want to emphasize is that standard setting it's a dynamic process, and nowhere is this truer than in standards for sustainability. So like they're evolving all the time as we learn and grow, and the best way to make sure that standards are fit for purpose, of course, is to engage with them. So if there are practitioners on the line, my concrete action is to test standards out and provide feedback. As a practical example, I know the UNDP have consultations currently open on their standards. But even if you're not a direct user of standards, if you have investments, if you have a pension, challenge your investment manager to how they're working to adopt best practices as they're developed. We've heard today that we're facing global problems and we're not going to solve them if we turn inwards and take our own approach. Like, collaboration is key. So join the conversation, work with standard setters, and let's get the job done.
I think it's great, James, as a reminder that these are not static, they are dynamic, but also a reminder, you don't have to start from scratch. So I think that those are two really important references. And I think your point about that these are alive and we're engaging with these standards is that it really is a global engagement. I mean, you've been the anchor convener of those global interactions, but we don't have separate standards for India as we do for Africa, or countries in Africa, or countries in the EU. And I think that's so powerful as we think about what does connect us in these considerations, and also the comparability of our experiences. So thanks for that reminder. David, I think we have time for one more question before I'm going to do a wrap up with the panelists.
Yeah, I think there's a very interesting question here, which is basically to get the perspective of the panelists on how we can ensure that impact investing becomes the new normal, and that it is traditional investing, or I suppose financial first investing, that becomes abnormal, recognizing its potential negative impact on people and planet. And so what's the next big step that we should take to ensure this transition for impact investing?
Great question. Great question. Jacco, let's start with you.
Well, I think when you look at all of the assets globally, then unfortunately, most of the assets are still almost not screened. And there is a sort of a range from there all the way to pure play impact investing. In the middle, we have some negative screening, ESG integration, and positive screening. So I think it is important that in each of these buckets, at least investors take one step up the range. We cannot even dream of people going all the way from the left to the right in one step. But if everybody moves up that ladder, and that is actually happening, we've seen this year, even though it's COVID year, that ESG and impact investing continue to grow, whereas mainstream was suffering from the crisis more. So that should be, I think, a reminder that this is a trend that is continuing also in COVID times.
That's fantastic. So take that first step. ESG can be a very basic first step to make sure you're at least on the A of the ABCs in the spectrum of impact. Fantastic. Neha?
Yeah, this is a fantastic question. Representing investors on this platform, because we are a group of investors at the end of the day, I think what lacks is the availability of data in the market, the lack of knowledge, the lack of exit data, the lack of the social enterprises capturing their impact measurement data. So I think if we can, as an industry, come together and solve that issue, I mean, even if it's through reports or, being a little more open or, about your exits, that'll be fantastic. And I think that is the need of the hour at this time.
I think that's a great point, because as you say, investment capital has a return trip associated with it. Absolutely. And let's understand what that return trip is. And what I find in my work is that investors care most about how does it come back in addition to what's the return of that capital or return on the capital, let me get it back first, and then I can think about the multiplier effect of the capital. Very good reminder, Neha. Thank you for that. James, how do we get to the new normal?
Yeah, that's a great question. So I guess from where I sit, I think one of the main things and one of the most exciting things is like regulatory movements around all of this. You know, we've got the EU consulting on their non-financial reporting directive. We've got the IFRS, which is consulting on their role in sustainability standards, and IOSCO, the group of securities regulators. They're all joining this conversation, and you know, lots of moving parts, but we're seeing it play out over the course of this year. And I think there's going to be some really significant changes that really bring consideration of sustainability into the mainstream.
A terrific reminder of the power of regulation, and that actually that's a real lever that government has. And as we're all experiencing, government revenue is certainly under constraint. There was a question in the earlier panel about the reduction of the aid budget here in the UK that was announced yesterday. But the government policy lever, the regulatory lever, is one that doesn't necessarily pull back when we have a revenue constraint. So I think it's a real reminder of the power of that, James. I think it's a great point. Thank you. And hopefully with COP26, we're continuing to move in that direction. It's great. Rosemary, how do we get to the new normal?
So it's going to be a mix of carrots and sticks, and James has very diplomatically given us one of the sticks. So I'll give you one of the carrots. I think is that most actors in the market have more demand power than they think, and utilising that we get into cycles of nobody's offering because nobody's asking, and nobody's asking because nobody's offering. Start using your place in the value chain to create demand, and the market will respond.
Oh, that is such a powerful invitation. You're completely right. It came up in the pension conversation. My money is in a pension, and I should express my voice and demand where that money is being invested. The Make My Money Matter campaign that was referenced earlier, and others. So no matter who we are, it's not just expecting institutions to do the right thing or to be pushed to do the right thing by regulation, but we as individuals have voice and power here. I think that's a great reminder, Rosemary. So I want to segue to our wrap-up question that I want to ask each of you. And Rosemary, I'm going to start with you this time and then go back the other way. And my question is that if we're reconvening a year from now, so it's the 2nd anniversary of the Institute, we're all together again, what do you want to be able to say about what has transpired in the coming year?
I want to be able to say that we look back and this is when impact was firmly put on the agenda. And that ranges from people learning their ABCs that James told us about. We should all know our ABCs of impact, and to leaders really setting clear signals that impact matters and starting to link it to purpose and strategy and the way they drive organisational culture and activity. And that means we start seeing people bringing impact into the boardroom, into decision-making bodies, because it won't fully be on the agenda and integrated until it's also incorporated in the decision-making.
Fantastic, clear, bold, consistent signals, and an invitation for leadership. Also, that's what you're really saying, reminding us, Rosemary. Fantastic. James, to you. A year from now, what do you want to be able to say?
For me, governments, business, investors come together. We've been able to vaccinate the world, beat coronavirus, and we have the momentum for the kind of global collaboration we need to beat and tackle climate change.
Fantastic. Talk about bold. I love that. Fantastic. Thank you. Neha?
Yeah, so I agree with James. I would love a corona-free world to start with. And but representing emerging markets, I think it might be a great idea to have a brand around, a narrative around the emerging markets. And for example, if India could be, the problem solver for the global stakeholders, and the other emerging markets, if we could create a brand around us, a narrative, it might take us a long way. So that's where I want to see us, India, going 1 year from now.
Terrific. And hopefully we will be in person when we have that reunion event. And Jacco, to you.
Yeah, no, of course, I agree with a lot of things that have been said, but I mean, investors, they vote with their money. So the first thing I want to see in 1 year from now is to see that impact investing has really grown tremendously. We do see nowadays that every second fund that is launched is an impact or sustainable fund. I have all the faith in the investors that they will be able to distinguish between impact washing and real impact. And I think, you know, given that I'm the last one to speak now, we should also look a little bit further and indeed make impact investing mainstream. May take a bit longer than 1 year.
Right.
Well, we'll keep coming back, Jacco, but I like that. You're right. We have a near-term objective and then a longer-term objective. But you're so right that actually at the end of the day, people's intent is translated into their actions. And we have to look through the lens of the actions. And that's certainly what all of you are about. It's certainly what the Institute is about. And I want to thank you all for sharing your perspectives and your contributions and making this conversation so interesting for all of us. Many of the references that were made in studies will be available on the Institute's website. I'd encourage people who are listening today to visit the Institute's website. It's updated regularly. Also, as Neha invited, there are a number of knowledge exchange events in the upcoming months. So we would encourage you to join us and participate there. And I just, from my point of view, I just want to close with picking up with Mark Carney said. I was really interested when he said that impact investing from his vantage point was one of the bright spots in 2020. I thought that was a really interesting observation. And I think it's, then all of us, we have both an invitation, but I would say a real obligation to make sure we remain a bright spot and a larger, bigger bright spot in 2021 as we come out of COVID, and that we don't resort back to what was before, but that this is a moment where impact pursuits, impact capital can really make a material difference in what the world looks like and how we live in the world from a social and environment point of view. So I want to thank all of you. They've enjoyed the conversation very much. And I'm now, for all of those of us online here, we have another one of our social spotlights with a great organization, Karkana in Nepal. So we're going to all enjoy that social spotlight. But thank you all for joining this Global Perspectives conversation.